I have two policy illustrations here that I want to compare and contrast and show you how I compare and contrast illustrations. So on the first one here, it's a 40-60 split with a $10,000 premium, annual premium. And my second one is a 90-10 split with a $10,000 premium as well. All criterias are the same. Same gender, same age, same health class, same state they live in, same premium amount. Everything is the same, apples to apples. The only thing that is different is the amount of cash that's being plugged in towards the base and the amount of cash that's being plugged in towards that paid up additions rider. So the first thing I guess I want to talk about is that first off, on the 90-10 illustration, we have to add on this term rider so the policy will not become a mech. Okay, so that's the only reason this term rider is on the policy. On the 40-60 split, you can see, hey, we don't need to have a term rider onto the policy. This policy is not a mech, right? So anyways, how I compare and contrast these illustrations is I take the non-guaranteed values. I'm always looking at non-guaranteed values. Well, why is that? Why am I looking at non-guaranteed and not guaranteed? Well, because here in the insurance world, we kind of have a joke about it, that, hey, the non-guaranteed side is really the guaranteed side. And the reason we say that is because with all the companies that we are affiliated with, they have been paying dividends for over 100 consecutive years. So I can't guarantee it, but there's a pretty good darn chance that they'll pay a dividend out next year, right? So anyways, with Mass Mutual, these are with the two illustrations I'm comparing, the company called Mass Mutual, which is kind of that bigger one. A lot of people are familiar with Mass. And so I'm going to go in, I'm going to show you how I compare and contrast illustrations and why I view one a little differently compared to the other, okay? So in year one, when I look at year one of the policy, I can obviously see that my 90-10 illustration is giving me the best cash value and death benefit. Okay, so what I'm looking at is I'm looking at my total net cash value and I'm looking at my total net death benefit within these policies. Okay, and so in year one, you can see, okay, I have $8,600 in my 90-10 illustration. That's my loan I'm able to borrow out. And in my second one, on the 40-60 split, in year one, I have about $6,300 I'm able to use and borrow out, right? So obviously the 90-10 is a little bit nicer in the early years, right? Because, reminder, why is it nicer? We're supercharging that paid up additions rider in the early years, thus it's making us cash value a lot greater in the early years, right? So in year 10, I see the same thing. $49,000 on my 90-10 illustration, $43,000 on my 40-60 illustration, right? So that's in year 10. Let's go down to year 20 though. Year 20, I'm looking at my 90-10 illustration and I have $197,000 that I am able to borrow out and use for that year. On my 40-60 illustration, I have $223,000 that I am able to loan out. If you do the math on that, if you take the 223,101 and subtract that from the 197,430, that's about $26,000 more that you would have in your pocket. And why is that? Why in the later years am I having more cash in this 40-60 illustration than I am on my 90-10? Because remember, this is why we want to plug dollars going towards that base premium. Okay, this base premium, this is what drives the cash value within the policy. Because remember, from the rocket ship example, those booster rockets are going to eventually fall off. And the only thing that's really going to be driving your policy is the premiums that are going towards that base policy. So wouldn't you want to have more funds going towards the base rather than taking it away and just supercharging it in the early years? Because reminder, we are doing this for the long term. Don't get hung up in short-term thinking, right? Let's keep going on. Year 30. In my 90-10 illustration, I have $329,000 I'm able to use. In year 30 on my 40-60, I have $410,000 that I am able to use. If you do the math on that, that's almost an $81,000 that you are able to take out of the policy and loan. Now, I know we don't talk about it a lot, but let's just look at the death benefit there in year 30. In year 30, on my 90-10 illustration, I have about $607,000 of death benefit. In year 30, on my 60-40, I have $755,790 of my death benefit. Do the math on that. Subtract the 755 minus the 607. What is that? That is a $148.49, right around there, $149,000 difference just in the death benefit. Just because we messed up the splits in 90-10 and a 60-40, right? So let's keep going on. Let's go in the later years. Let's keep going for 2 more times, right? In year 40, on my 90-10 illustration, I have $528,000 that I am able to loan out. In my 40-60 illustration, I have $695,000 I am able to loan out. Do the math on that, folks. That's a $166,000 difference. Shoot, I can go buy a house with that, right? Anyways, let's go to my last and final year. I typically go down to about year 50 to 60, right around there. That's how I compare and contrast. But please keep going and you'll see this. But anyways, right? In year 50 of this policy illustration, and when my gentleman is 88 years old, he's going to have $787,900 that he is able to loan out from his policy. This is on the 90-10 split, right? On the 40-60 split, if he would have went with this illustration, he would have $1,079,746 that he is able to loan out from his policy. And do the math on that. Do the math. That's almost a $300,000 difference. 300 grand. That's a big difference. So do you see now why it is important to fund dollars towards that base premium? And why we need to not think of this concept as a get rich quick scheme, as a return, a rate of return on investment. This is not about rates of return. This is about a process and a concept that we are going to be adding to your financial life. Just one extra step. Okay, and last and final, let's take a look at that death benefit. If he passes when he is 88 years old, on his 90-10 illustration, his family would get $938,000 of death benefit. When he is 88 years old, on his 40-60 illustration, he has 1.2, almost 1.3 that he is able to leave to his family and start a legacy with. Do the math on that. Take the 938 and subtract the 1.2. That is almost a $350,000 difference. 350 grand that you are not leaving to your family by living in the instant gratification era and going with this 90-10 illustration.